Okay, so now we are starting with the economics, and the most important chapter in the economics always is currency. And trust me, students really face lots of issues when it comes to currency. Trust me, lots of issues. Means what is your beta spread, how to convert the currencies, cross exchange rate, arbitrage. So many confusions are there to the students, and really they suffer a lot. Okay, so over here with this lecture, my aim is to simplify the chapter to ensure you that you will be able to understand the chapter very easily, and after watching this lecture your concepts will be as smooth as possible. You don't have to take the burden of understanding the currency. Clear? That's what my point in this particular lecture. Now the whole chapter divided it into three parts. Part 1 is about the quotes, okay, that how the currency exchange rates are written, their spread, arbitrages. So it's purely on a calculation part with respect to currency. Second part is about different theories of currencies. And third part comes with the macro, means where we talk about the balance of payment, okay, how the central banks are taking actions to actually control the flow of the money in the market, how they are creating the influence current account, capital account, okay. Some models will be there, how a central bank coming up with different perspectives, different methodologies to increase or decrease the supply of the money into the market, including the interest rates. Clear? So I start off with this part 1, that is calculation part, understanding the crux of the currencies. Clear? Now always remember, currency when it comes to the spot market, where you want to buy currency or you want to sell currency. So there are two parties involved, party A and party B. Party A is actually a dealer. Party A is actually a dealer. Okay. Now his task is to buy currency. His task is to buy currency as well as to sell currency. Clear? He buy currency as well as he sell currency. Clear? Suppose he is selling dollar. So when he will buy at the rate of 70 rupees per dollar, and when he will sell at the rate of 71 rupee per dollar. Clear? So he is buying at 70 and he is selling at 71. How much he is earning per dollar? His profit is rupee 1 per dollar on every dollar traded with him. Clear? Who is Mr. B and who is Mr. C? Mr. B is the buyer of the currency, like you and me. He is the buyer of the currency. And who is Mr. C? He is the seller of the currency. Seller of the currency. So Mr. B have, say, suppose $100. Sorry, Mr. B have, say, rupees 7100. Mr. B have rupees 7100. Now he want to buy the dollar. Now he want to buy dollar. He will approach Mr. A, because Mr. A is the dealer. Mr. A is the dealer. He buy and sell currency. So Mr. B approach Mr. A and he say that I want to buy dollars. I have 7100 rupees. Can you give me dollars? He will say yes. Clear? So dealer need to sell the dollar. Dealer need to sell the dollar. So which rate he is going to use? 71 rupee per dollar. Then how much? Write down how much dollar received by Mr. B. Write down, the answer is $100. How? He have 7100 INR divided by what is the rate? 71. So what I am left with? $100. Clear? Now Mr. C, he want to sell dollars. He want to sell dollars. He have $100 in his pocket. He have $100 in his pocket and he want to sell the dollars. He want Indian rupees. So he will approach Mr. C. So this time Mr. C needs to buy dollar from Mr. C. This time write down case 2. Mr. A needs to buy $100 from Mr. C. Then he will apply the rates of rupees 70 per dollar. Clear? Then Mr. A will pay how much? Mr. A will pay 7,000 rupees to Mr. C. Mr. A will pay 7,000 rupees to Mr. C. Now see what happened in the hands of Mr. A. Mr. A received 7,100 from Mr. B. Clear? And he gave him $100. Clear? Now, Mr. A received $100 from Mr. C and he paid Mr. C how much? 7,000 INR? 7,000 rupees? Clear? Now, let us see. This part cancelled out each other. $100 inflow, $100 outflow. Inflow of 7,100 rupees and outflow of 700 rupees. So what is the profit of Mr. A? What is the profit of Mr. A? It is going to be rupees 100 per $100. Rupees 100 per $100, or you can say rupee 1 per $1. For every dollar he is making the profit of 1 rupee. Clear? Are you getting my point? So this is what I have explained you from the perspective of Mr. A. Clear? That he will buy at lower rate. You want to write, you can write down Mr. A or dealer. He wants to buy at lower rate and he wants to sell at higher rate, and the difference will be his profit. And the difference will be his profit. Again, I am saying the line. If you want, you can write it down. Mr. A wants to buy at lower rate and sell at a higher rate. Then only he will be able to make the profit. Clear? But now, try to understand. Do you think that this $100, that 100 rupees he made the profit, that 100 rupees he made the profit is risk free? No, this is actually not risk free. Why? Try to understand. Mr. A is in the market. He is a dealer. He is quoting the exchange rate of 71, the rate to buy and the rate to sell. But suppose people found out that his rates are very good. His rates are very good from the 71's perspective. Means when people are buying from him, the rates are very competitive. Why? Because over here we have another dealer. He is quoting the rates like this, 70 and 71.20. So means if people like me who want to buy dollar, try to understand. If I want to buy dollar, how much INR I need to pay? With respect to Mr. A, I need to pay 71. With respect to Mr. B, I need to pay 71.20. Clear? So I need to pay extra. So if people want to buy dollar, whom they will approach? They will approach Mr. A. And at the end of the day, Mr. A found out that he sold dollars. He sold dollars for $10 million. And he bought dollars only of say $6 million. So he is in a net short position of $4 million. He is in a net short of $4 million. Clear? Net short position of $4 million. And what if the price of the dollar will rise? He will lose money. On this. What he need to do now? He need to do the hedging. To protect himself from the rise in price. If the price will rise, he will lose. Why he will lose? Sir, because he sold huge amount of dollars. As compared to buy side. And short means what? If the price will rise, if the dollar price will rise, he will lose. Why? Sir, because he is net short by $4 million. So he need to do hedging. Or another option, he need to wait that he might get $4 million buy side. But what if it will take huge amount of time and he will make the loss? What if this will take huge amount of time and he will make the loss? Clear? Another option. Another option, that he want to make this side more attractive. He want to make this side more attractive. Means if he can sell his currency, means now he want to make this side, this 70 side, more attractive. What is the 70 side? 70 side is his buy side, the price at which he is buying. And what is this? The price at which he is selling. So when he say that I want to make this more attractive, when he is buying, others are selling. When he is buying, others are selling. And when others are selling, and if they are getting better price, they will sell to Mr. A more. Now Mr. A came up with the new pricing as 70.50 slash 70.50 slash 71.40. 71.40. So now you will see that this side will become less attractive. Now people will not come and buy from him. Why? Because he is very, but he is offering good amount when people are going to come and sell goods to Mr. A, because Mr. A is paying 70.50 for every dollar. So this is the one way, by changing the rates which he is offering to the customer, to attract the customer and cover his $4 million. Clear? Okay, so I have given you a good glimpse of idea from the dealer's perspective. Now the tone of the topic will be mostly from the perspective of the customer. Clear? If I am posting the quotes like this, 70/71, and if the customer wants to buy, he will buy at a higher rate, and when customer wants to sell, he will sell at a lower rate. Make sure you will not get yourself confused with this point. He will buy at higher rate and he will sell at lower rate. Clear? For customer, spread is a cost. For dealer, spread is a profit. Clear? Now suppose I write a quote for you. Now suppose if the rates in the market are quoted like this, for dollar 1.15 per GBP. So what is GBP? It's a Great Britain pound. Okay, British pound basically, and it is written with the sample like this. Okay, so for 1 pound, how many dollars you are getting? 1.15. For 1 pound, how many dollars you are getting? 1.15. Also always consider this as your base currency. This as your base currency, and this is your price currency. So always focus on this. Always focus on this, that 1 pound is equals to $1.15. This is the price of 1 pound. $1.15 is the price of 1 pound. Always read it like this. Your half of the problem will be solved. Clear? So if in the market the rates are like this, then what the dealer is going to quote? Dealer will quote 1.14 and 1.16. Means he is going to sell at this level and he is going to buy at this rate, dealer. But when it comes to the customer will sell at this rates and he will buy at this rate. Clear? So whenever you want to buy 1 pound, write down, when you want to buy 1 pound, you need to pay dollar 1.16. Clear? And when you want to sell 1 pound, when you want to sell 1 pound, you will receive you will receive you will receive dollar 1.14. Are you getting my point? For me for me I'll buy here, and for me I will sell over here. Clear? Don't get yourself confused in buy and sell. You will buy at a higher price, you will sell at a lower price. Half of the things are done over here. Now, if I talk about some major top 8 tradable currencies in the world, top 8 tradable currencies in the world, let us make the note out of it, because this knowledge is also needed. Okay, means bookish knowledge will not do the needful. You also need to have the information of the market as well. So I'm going to tell you about the top 8 major currencies of the world. Number 1 is US dollar. US dollar, it is termed as USD. Then we have European euro. European euro, we mention it as EUR, European euros. Write down the symbol, it's like this, European euros. Clear? Then we have Japanese yen. Japanese yen, JPY, Japanese yen. This will be written like this, Japanese yen. Write down point number 4, British pound. British pound as GBP. British pound as GBP. Symbol I have given to you over here. This one. Okay. So mention it over here. GBP. Clear? Write down fifth. Fifth is Swiss franc. Swiss franc. CHF. This is something written like this. Your F and then a small strike over here. Okay. These informations are needed not for the purpose of exam, but yes, for the purpose of your self knowledge. Okay. Then we have Canadian dollar. Canadian dollar. CAD. Canadian dollar. CAD. So what is the symbol for CAD? Anyone? Try to think. Symbol is same as dollar. Okay, Canadian dollar. It is same as normal dollar. Then we have Australian or New Zealand dollar. Australian or New Zealand dollar. Then is the South African rand. Write down South African rand. ZAR. ZAR. So this will be written as AUD and this will be written as NZD. Symbol is same as dollar. Okay, the same which we are using for the US dollars. Clear? And one symbol left is for South African rand. Think, try to think. Have you ever seen this before? Have you ever seen this before? It is going to be pure simple letter as R. This is the symbol. Clear? For ZAR. So now if I tell you some of the data like 1.008 euro per USD. Okay. Then 0.8704 British pound. British pound, GBP per USD. Clear? If I tell you 1.47, 1.4755 AUD per USD, AUD Australian dollar. Clear? 1.3164 Canadian dollar per USD. Clear? Then 1.4061, 1.4061, it's Singapore dollar, Singapore dollar per USD. You remember CHF 0.9834 CHF per USD. Clear? If I talk about Japanese yen, 140.5324 Japanese yen per USD. Clear? If I talk about Chinese renminbi, it is 6.9404 per USD. Okay, it is renminbi, China. So these are the major currencies and their rate with respect to USD. Clear? So you can see that you have two prime currencies which are even better than USD. One is CHF and another one is GBP. Clear? Even Euro is closer to USD. Euro is very closer to USD. Now let us take one question from this only. Let us take this one. 0.8704, 0.8704 per USD. Clear? So for 1 USD, how much pound you will get? 0.8704. If I want to know for 1 pound how many USD you will get, 1 divided by 0.8704. So it is rounded off to 1.15, which I have explained you earlier. Clear? So means rates are approximately going the same way. Clear? But now if I want to write it in the form of a question. Suppose a dealer is quoting the rates $1.14 per pound and $1.16 per pound. Clear? Now write down, you have $50,000 in your pocket and you want to convert this into pound. You want to convert this into pound, and you are saying that you want to convert this into pound means you want to buy pound. You want to buy pound, and whenever you have to buy at a higher rate. Higher rate is this one. Higher rate is this one. Now you have $50,000. You want to convert it into pound. Rate is given for the pound. Cash which you have is in dollars. So how you will be converting this? How you are going to convert this? So always remember, if your base currency is different and the money which you want to convert is different, then you have to use the divide function. Simply 50,000 divided by 1.16. Do it fast. 50,000 divided by 1.16. How much? 43103. It is pound 43103.448. When you will convert your $50,000, you are going to get this much amount of pound. Are you getting the point? Clear? Let us have another question. You want to buy pound, you want to buy dollar from 60,000 pounds. You want to buy dollars from 60,000 pounds. Now always remember, buy dollars means buy dollar means sell pound, sell dollar means buy pound. Now why I have converted this into pound? The reason is that my base currency is in pound terms. So over here I want to buy dollars, means I want to sell pound, and whenever I am going to sell, I am going to sell at a lower rate. So I am going to utilize this. So what rate? 1.14. 1.14. Multiply or divide? Multiply. Why? Because the cash which you have is in the base currency. So it is going to be multiplied with 60,000. It is going to be multiplied with 60,000. Tell me, what is the amount? 68400. 68400 is the dollar amount. Trust me, once you have concept like this, you will never forget it. Clear? Again, you want to sell dollars to dealer. You want to sell dollars to dealer and you have $10,000. And when you want to sell dollars, means what? You have to buy euro, and whenever you have to buy at a higher rate. So what rate are you going to use? 1.16. So 1.16. Multiply or divide? Divide. Why? Because this is your price currency. So means 10,000 divided by 1.16. Clear? Write down. You want to sell 40,000 euros. You want to sell 40,000 euros. Clear? So when you want to sell it at a lower rate. That means 1.14. Clear? Multiply or divide? Multiply. Why? Because this is in your base currency. Clear? So when you have practiced it like this, when your concepts are strong enough to ensure that you can practice it in this way, where you can settle down with the concepts, things will sustain for the longer term. Now trust me, if you'll practice it twice and thrice with few more questions, then this is going to sustain with you for longer time. Okay, now this part is done, where you have good concepts over how to convert your currency, what rate you are going to choose. Clear? Now when it comes to the currency market, there is a cash market, there is a term market, there is a spot market, and then we have a forward and futures market. Cash means what? Immediately you give $10,000 and take the converted, whether INR or whether euros or whether pound, whatever, immediately. Immediate transaction. Term means today you had a contract and tomorrow it will be settled. Means whatever you have to give or take, it will be happen tomorrow. Spot. Today you enter into a spot, means it's like buying a shares. Today you buy the shares. Shares will be credited to your demat account after 2 days. So spot means it's T+2. Okay. And forward depends upon your contract size. It can be 30 days, can be 60, can be 90 or 180, or it can be customized. Clear? These are the 4 different forms of markets in the currencies. Now coming to the next point, which is about the spread. You remember I told you 1.14 pound per dollar and 1.16 pound per dollar. Clear? This one is bid rate, this one is ask rate for the dealer, and over here dealer is enjoying 0.02 pound per USD. 0.02 pounds per USD. Clear? This is the spread, this is the profit which is made by the dealer. Clear? Now the spread depends upon many factors. This particular spread, it depends on many factors. Means if I tell you a dealer had a good relationship with a particular customer. He's holding FDs, he's holding his current account, savings account, he's having the good investment in the bank. In that scenario, the spread is going to be lower. Spread is going to be lower for that particular client. Clear? Second, if you are getting the huge amount of volume, means Mr. C is coming with $10 million buy, $10 million buy trade. In that situation, the spread is going to be higher. Over here you will think that when volume is high, then spread must be lower, but no, it's not the fact. The reason is that Mr. A, who is the dealer, if he is getting trapped on one side, when he is getting trapped on one side, say the rates are quoted like this, 1.14 pound per dollars, and someone came and they bought the dollars, they bought the dollars at this point, they bought the dollars, means what? Dealer is huge short side over here, and there is a possibility he can make huge amount of loss if the price of the dollar will rise. Why? Because someone bought the dollar, someone bought the dollar at this rate in huge quantity, and he got trapped at one side. So how he will make up his loss? By putting up the higher spread, by putting up higher spread. Clear? Third is the interbank wholesale market. Interbank wholesale market means dealer is just a part of that wholesale market. In the wholesale market, there are billions and trillions of currency exchanges going on. Over there, generally the spread is lower as compared to the spread in the hands of the dealer. Clear? Because dealer wants to make good amount of profit with the small amount of transaction, because in the hands of the dealer the volume is less. So if he want to make the profit, he needs to keep the spread at a higher side. But in the interbank, the spread depends upon many factors. Okay, what are those factors? Number one is the currency involved. If I talk about the currencies like USD, Euro, Pound, okay, AUD, CAD, Japanese yen. So these are very popular currencies available in all market. Available in all market. But if I talk about some currencies which are not much popular, okay, not much popular, like Hong Kong dollar, okay, or even this is also considered to be as one of the most premium one. But suppose if I tell you, yes, Sri Lankan rupees, they are not much popular, okay, and there is not huge buy and selling going on for these type of currencies, so spread is higher. So spread is lower for popular currency. Why? Because they know that if someone buy AUD, then someone will definitely come and sell AUD, because the market is liquid, there is a huge buying and selling going on. But if I talk about a Sri Lankan dollar, okay, or Pakistani rupees, or Omani real, okay, these are not much popular, okay, or you can say Malaysian currency, Kuwait currencies, these are not that much popular. So in that situation, you need to keep your spread higher. So type of currency, if it's popular, spread is lower, if it's not popular, spread is higher. Second, time of the day. Time of the day. They are saying that if there is a point of time when multiple markets are opening, if there is such common time where multiple markets are opening, clear, then if you had AUD buy from this market, you can take a short position from these markets, clear. But if there is suppose only one market which is open at a point of time, and in that situation it become difficult to hedge yourself. Why? Because other markets are closed. But when other markets are open, you can buy from one market, you can sell it from another market, because at that point of time the liquidity is higher as compared to the single market opening time zone. Now write down third point. Third point is about the volatility. Third point is about volatility. Volatility means what? Risk. Risk, higher the premium, higher the spread. Higher the volatility, higher the risk, higher the premium, higher the spread. Clear? And the last one is the maturity of the contract. Maturity of the contract. If the contract maturity is far away, means you are entering into a contract of, one contract is of 60 days and another contract is of 180 days. So which one is more risky? 180-day contract is more risky. So if there is more risk, there is more spread. Clear? Why? Because there is a possibilities of credit risk, okay, market risk, liquidity risk. So many risks are there, but this is a 60-day period, a small time where you will not consider the credit risk or market risk much, but in the period of 6 months there is a possibility of anything can happen. So I have discussed one important point over here, which is about the spread. Clear? So till now we have covered 2 points. Point number 1 is the understanding of the currency, the buying and selling, the buying and selling, at what rate you will buy, at what rate you will sell, how to convert and how to exchange. And second is about the spread. Second is about the spread. These two core important points we have covered up. Now let us understand some of the few important facts about the currencies. Some information is also needed. Okay, so if I will ask you, which one is the most strongest currencies in the world, which one is the most strongest currency in the world, most of you will think whether it's dollar or euros or pounds, but the answer is wrong. The answer is KWD. Okay, this comes from Kuwait. Okay, why? Because the economy of the Kuwait is very strong, and the full form of the KWD is Kuwaiti dinar. Write down Kuwaiti dinar. They, why their economy is strong? Because of the export of oil. Export of oil. Clear? So if you want to know the amount, it is like 0.30 0.3085 per USD. Per USD. For 1 USD, you are going to get only this much Kuwaiti dinar. So you can see that it's close to 3.5 times of the dollar. Close to 3.5 times of the dollar. And this is also considered to be as the most valuable foreign currency in the world, and it does not rely on any peg. It floats freely in the market. Clear? So this one is about the strongest currency. Which one is the most weakest currency? Weakest currency comes from the Iran. Weakest currency comes from Iran. Clear? We all know that Iran goes from many problems. Okay, one of the major problem is that their revolutions, that Islamic revolution which happened in 1979, and then foreign investor took their money off from the country, and that leads to the devaluation of the currencies. Clear? Now if I'll ask you a simple question, how many currencies are there in the world? How many currencies are there in the world? Then we have 180 different currencies which are circulated around the globe. Write down. These notes are helpful for your knowledge, not for the exam. 180 different currencies revolving around the globe. Now you have seen that Japanese yen is so small, means the currency amount is so small. If you remember, I told you the amount, I guess it was 140 yen per dollar. It was 140 yen per dollar. But I told you that this comes under a very strong currency. Then why there is such a huge gap? What is the reason? The reason is the interest rates. The interest rate gap between the US and the Japanese yen. Clear? That we will study bit later. Now if I talk about some more important figures, like which Asian country is richest in the sense GDP per capita, means per capita income, where it's the highest? It's in Singapore. In Asia it comes as the first, and if I talk about the world, then it comes at the second level. Clear? And if I'll compare this with India, in Asia it comes at 129, and in the world, sorry, in Asia it comes at 38, and in world it comes at 129, and these are the 2021 figures. Okay, I'm not considering 2021. And suppose if I'll compare the same with some known countries, say China. Okay, China, this one is about India. China stands where? 21 and 76. Clear? This is the ranking of Asia, and this is the global ranking. If I talk about Sri Lanka, 25, 25, 94, Sri Lanka. This is the ranking based on per capita GDP income. Okay. Okay. So let us keep this much in this lecture. We'll continue ahead in the second lecture. Thank you.